Compliance audit, fraud investigation, value for money audit and management audit. Compliance audits focus on determining whether organizational activities follow internal policies, procedures, and external regulations. Internal auditors examine whether employees and departments comply with established control systems, operational procedures, and legal requirements. This may include reviewing documentation, testing samples of transactions, and verifying whether controls operate as designed. Compliance audits help organizations ensure that internal controls are functioning properly and that activities are carried out according to prescribed standards. If weaknesses or non-compliance are identified, the auditor will recommend corrective actions to strengthen procedures. Compliance auditing therefore contributes to risk management by ensuring that rules are followed consistently and by reducing the risk of operational errors, fraud, or regulatory penalties. Fraud investigations are conducted when there is suspicion of dishonest or illegal activities within the organization. Internal auditors may be asked to examine transactions, records, and operational activities to determine whether fraud has occurred and to identify the individuals responsible. These investigations often involve detailed analysis of financial records, interviews with employees, and examination of control weaknesses that may have allowed the fraud to occur. The aim is not only to detect fraud but also to recommend improvements to internal controls to prevent similar incidents in the future. Fraud investigations therefore play a key role in protecting organizational assets and maintaining stakeholder confidence. Value for money, VFM, audits and management audits assess whether organizational activities are conducted economically, efficiently, and effectively. A value for money audit examines whether resources are acquired at the lowest cost, economy, used efficiently to produce outputs, efficiency, and achieve intended objectives, effectiveness. A management audit goes further by evaluating the performance of managers and organizational structures in achieving strategic goals. It may involve reviewing policies, decision-making processes, resource allocation, and operational workflows. These audits help identify inefficiencies, weaknesses in management practices, and opportunities for cost savings or improved performance. Operation of internal audit. Internal audit operates as an independent assurance function that evaluates and improves risk management, governance, and control processes. Internal auditors provide objective assessments of whether the organization's systems of internal control are effective and functioning as intended. They review operational processes, financial reporting systems, and compliance with laws and internal policies. Although internal auditors do not manage operational activities themselves, they provide advice and recommendations to management on how to improve controls and reduce risks. This independent evaluation supports management and the board in achieving organizational objectives by identifying weaknesses in processes and suggesting improvements. The internal audit process typically follows a structured approach involving planning, testing, and reporting. The audit begins by agreeing the objectives of the engagement and developing an audit plan. Auditors then gather information about systems and controls and assess whether these controls are adequate to manage identified risks. The next stage involves testing whether controls are actually operating as intended through compliance testing or substantive procedures. Finally, auditors evaluate the results of testing and prepare a report outlining findings and recommendations. This structured process ensures that internal audit work is systematic, evidence-based, and aligned with organizational risk priorities. Modern internal auditing often uses a risk-based approach to ensure audit resources are focused on the most significant risks. Auditors assess the organization's risk profile and concentrate their work on areas where the potential for errors, fraud, or operational failure is greatest. This approach improves the efficiency and effectiveness of internal audit activities because time and resources are directed toward high-risk processes rather than routine checks of low-risk areas. By prioritizing audit efforts according to risk exposure, the internal audit function provides more valuable insights and contributes more effectively to organizational risk management. Assessment of audit risk. Audit risk refers to the possibility that auditors may reach an incorrect conclusion about the effectiveness of controls or the accuracy of information. In internal auditing, audit risk arises when auditors fail to identify significant weaknesses or errors within a system. To minimize this risk, auditors must carefully plan their work, identify high-risk areas, and design appropriate testing procedures. Proper risk assessment ensures that audit resources are directed toward areas where potential problems are most likely to occur. Effective management of audit risk is therefore essential to maintaining confidence in the audit process and ensuring that organizational controls operate effectively. Audit risk is often analyzed in terms of different components, including inherent risk, control risk, and detection risk. Inherent risk arises from the nature of the activity being audited and exists regardless of internal controls. Control risk refers to the possibility that the organization's control systems fail to prevent or detect errors. Detection risk occurs when the auditor's procedures fail to identify existing problems. By understanding these components, auditors can design testing procedures that reduce the likelihood of incorrect conclusions. Managing these risks ensures that audit findings are reliable and meaningful for management decision-making. Sampling introduces additional risks into the audit process, known as sampling and non-sampling risk. Sampling risk arises when the conclusions drawn from a sample differ from those that would have been reached if the entire population had been examined. Non-sampling risk occurs when auditors apply inappropriate procedures or misinterpret evidence. To reduce these risks, auditors must design appropriate sampling techniques, ensure sufficient evidence is gathered, and apply professional judgment when evaluating results. Effective management of sampling risks helps ensure that audit conclusions accurately reflect the overall condition of the systems being reviewed.